Well, good morning, guys. I think we should get it underway. Yeah, it's 9 o'clock. So, welcome. Thank you for joining Shakespeare Partners webinar today on JobKeeper 2.0. It was hard to believe that we presented our first stimulus webinar way back in April earlier this year. It's 5 or so months ago now, and so much seems to have passed since. But in many ways, for us, it feels like it wasn't all that long ago. And what we have seen in WA particularly is we've largely been fortuitous that the restrictions have eased relatively quickly, or certainly in relative terms, versus the rest of the country. And for the majority of our clients, being able to trade and operate together with some of the government stimulus that's been available has left the majority relatively well placed. There have, of course, been many significantly impacted by the ongoing COVID restrictions, and as a result, the government's announced a whole bunch of additional stimulus that they've titled JobKeeper 2.0. So today we wanted to update you guys just on those rafts, the round of stimulus, JobKeeper 2.0, and we're lucky enough to have our good friend Andrew Smith here to give us an update. I'm sure he can elaborate on some of the depth and details of the JobKeeper updates he's provided over the past 6 months. I'm sure there'd be very few Australia-wide that would have the knowledge that he does. So we're very lucky to have him to be able to give us and share his knowledge today. So without further ado, Andrew, welcome, and we look forward to the update.
Thank you, Stu. Thanks all to all the panel. Good morning to everyone. I'm just trying to send you a message, which I hope I've done. So we've got a message over there in the chat box. If anyone wants to ask any queries on the way through, I presume people can yell them out, although I'm not sure about that, Stu. Is it just a one-way webinar, or can people, but certainly people can send queries in via the chat box if they are unable to yell out. And obviously we've got a panel of experts here. So anyone who has any queries at all, just ask them, and hopefully Aidan or Stu or Leanne or someone else can help me out when I'm not sure of the answers. Now, I'll get to why I might not be sure of the answers in a second. So for those of you who remember the first session, when we did this amazingly, as Stu said, almost 6 months ago, we didn't know a lot of the things, because the way that this whole process worked with the original JobKeeper was that the government announced it, then provided us with no detail. And then, as I'm sure a number of you were aware, we kind of had to, soon the ATO will release some guidelines telling us how this works. Obviously, that was not a great model, but the government decided to follow exactly the same model this time around. So they announced JobKeeper 2.0, the extension to it, and then they left all of the detail to the ATO. And some of that detail we got as recently as last Friday. So just to give everybody an idea of if you've been asking questions over the last little while and wondering why you haven't got detailed answers, it's because we didn't have them. So I'll launch into, I think some of us will be more across this than others, but I'll go through some of the basics. And as I say, any questions that anyone's got, please just yell them out or type them out in that chat window. As I'm sure you've all heard, the government has extended JobKeeper for 6 months, but it's not as straightforward as that. So everybody who's on the original JobKeeper, in theory, that ended a couple of days ago on the 27th of September. And from the 28th of September, you have to reassess your eligibility. And whilst the government says it's a 6-month extension, it is, but it's really 2 3-month extensions that you have to re-qualify for each time. So if you're currently on JobKeeper, it has come to an end. You will get the next 3 months if you meet certain requirements, and then you will get the 3 months after that if you meet certain additional requirements. There also has been some changes to the way that we calculate how much employees get, the amount that employees get, and also the date on which employees are eligible. And I'm planning on going through each of those. I will do it as a sort of an overview level, And if anyone's got any queries, as I say, more specific queries, just yell them out or type them out as we go through, or at the end, or whatever suits you. So as I say, it's extended for 6 months. You're going to have to reassess your eligibility. There are some changes around employees, and we now have a 2-tiered payment system. So previously it was simple. If an employee was in, they had to get $1,500 a fortnight. Now that isn't the case, and we'll go through that as we go through. So eligible businesses, this is a very simple slide that I don't intend to spend any detail on, other than this is essentially the slide from the beginning of the year, because nothing's changed. So your basic eligibility for JobKeeper is that you're in business, you satisfy a fall in turnover test, and you had an ABN at the 12th of March, and you met some other basic criteria. That has not changed. And I've noticed we've already got a query come through, so I'll let the other panel members read that. And if you can answer that, let me know. So I'll just launch into some of the overview, and I'll start to work through some of those questions. So extension eligibility, the first extension eligibility is from, as I say, the 28th of September. Now, previously there were multiple methods to work out your eligibility, as in you could do it monthly in arrears, you could do it monthly in advance, or you could do it quarterly in advance based on an estimate. Under the new rule, it has to be based on actual numbers, and initially it's actual numbers for the September quarter. So the quarter ending 30th of September. And it is a quarterly extension, a quarterly measure, whether you are on monthly or quarterly. So if you're on monthly, you just have to add up the 3 months for the September quarter. Prima facie, this 30% reduction is based on a comparison between the quarter ending 30th of September 20 versus the same quarter last year. And we'll get to the fact that for some of you that won't fit. You'll have had unusual circumstances. There is alternative tests, as there was in the original JobKeeper. They are slightly different alternative tests. We'll touch on them. Now, I've used 30%. You'll see down the bottom in very small, this will be particularly challenging if you're on a phone, but it's 15% for not-for-profits, and it's 50% if your business happens to turn over more than $1 billion. So for most of us that are in business turning over less than $1 billion, it's 30%. So I'm going to use 30% as shorthand, because that's the easiest way to do that. Now, I have got a series of queries. Has anyone looked at those? Aidan or Stu, to see whether...
Okay, mate, we're looking at them. We'll probably come back and
come back to them as we go through.
As you go through, yeah. I think you've covered most of the answers.
So we'll get to them as we go through. So basically, the guts of it is, do I get JobKeeper from now? Well, the first test is, is your turnover down 30% for the September 20 quarter versus the September 19 quarter? And if the answer to that's yes, then you're in. There is a couple of little issues there, though. So I'll cover probably the second part first. So having qualified for the first extension, the second extension, so I said it's really 2-3 month extensions, will require you to do this same 30% test for the December quarter. So that would be December 20 compared to December 19 quarters. And again, you would have to be 30% down. So if you get in now for September, you're getting in for 3 months, and then you'll have to re-qualify again. Now, there is one significant change that's occurred to the way that you have to calculate your turnover. So when they announced the original JobKeeper, and some of you will have been through this, you were able, a number of clients, a number of businesses report their accounting on an accruals basis, but you do your GST and your BAS on a cash basis. Now, in the original JobKeeper, you were able to choose whichever of those methods suited you best to work out whether you qualified. Under the new rule, assuming you've been registered since the beginning, so remember you're testing September 19 quarter versus September 20. So the start of the September 19 quarter is 1 July 19. Assuming you've been registered for GST since then, right the way through, whatever method you've been registered and reporting your GST, which might be cash, you will have to use that method for working out your September turnover. So unlike JobKeeper 1, where you could flip-flop, you could choose whichever one worked best for you or best represented your business, you now can't. And that does create some weird outcomes. So for clients that have had, for example, a terrible September quarter, but they did a lot of stuff in the June quarter that didn't get paid until July or August, that will often, if they're on a cash basis, end up causing some problems. Stu, you just unmuted, so I presume you're about to add something, or was
No,
that...
you
Yeah.
hit the nail on the head. We've
Yeah.
had a few examples of clients exactly in that
Correct.
boat, which is
Correct.
yeah.
And it's the reason for it is when they originally announced JobKeeper 1, it was a free-for-all. You could literally choose whichever, and people were jumping between each method to get an almost manipulated outcome. So the government tightened the rule under JobKeeper 1 and said, well, you can change method, but only if that gives a more accurate position of where your business is at effectively. This time, they've just gone, nah, it's whichever method you're registered for. And that is resulting in a number of unfortunate outcomes where clearly people should qualify and won't. But without wanting to sound like, a presidential debate, it is what it is. There's literally nothing we can do about that. There's not even, at this stage, there's not even a discretion in that rule that the ATO can exercise. So it's just, it just is. The other thing that they have done, and I've just put this up as a simple slide, don't worry, I'm not going to click on all of those links. As of last Friday, they have announced a series of alternative tests, and some of you will have been through this process the last time. The most obvious issue here is, as I've just said, you're comparing September 20 to the September 19 quarter. And the problem is what happens, for example, if you're a client that wasn't trading for some or all of the September 19 quarter, you only commenced business in October 19, for example. So obviously that test wouldn't work for you. So they have a series of tests for businesses that started after that date. And then there's, what if my business acquired another work site or another shop or another outlet? There's a test for that. What if my turnover went up massively for a few months and then it's gone down? But when I compare now to the same time last year, I'm not down 30%, but I'm really down 60% overall because I went up and then down. There's a test for that. So there's tests for all these different areas where you might go, but that standard test doesn't work for me because of circumstance X. If you fit in one of those circumstances, and they're quite broad, there is likely an alternate test, and that test might work for you. So I don't know that we want to go through all those tests, Stu. Would that be right?
Yeah. No.
Because it will drive everybody to distraction, including the panelists in all likelihood. So all I want to do is flag that for those of you that have been through this process before, there is an alternate test or a series of them. So if the straight up 30% doesn't work for you, my phone's started talking to me because apparently I said something that sounded like Siri. I do apologize for that. So basically, just be aware that 30% test September quarter, that doesn't work for some reason. Can we get you in one of these alternate tests? And that's the way that that will work. Now, the other thing that's changed, the other thing...
Andrew, just on that, we do have a question from one of the panel on just the 30% test, asking if there's a sliding scale. So if you were down 15%, do you just want to talk to that?
Yeah, so it is a you're in or you're out test, unfortunately. So if you're down 29% for the September quarter, you don't get JobKeeper. If you're down 31%, you get all of JobKeeper. So unfortunately, it's and that does create some angst because there are people that are right at the border, and you can then have discussions with your whoever your particular advisor at Shakes is. Around whether you've got your turnover right. There are some really complicated rules around what should and shouldn't be included in turnover. So if it's that marginal, there may be something we can look at to see if we can get you in. But no, you're either in or you're out on that 30%. Sorry about that, Says. Sole trader grossed over 4,000 in this. Do I still qualify for JobKeeper?
We'll come back to that one, mate.
Come back to that one. Okay. So if we look at, sorry, Leanne.
There's also a question from Says about, can you be eligible for the extension 2 if not eligible for extension 1?
Yeah, so the way it works is when this was originally announced, it was quite clearly announced as an extension that would only be available to people who are in JobKeeper. And the announcement that followed that, or the suggestions that followed that, would be that if you didn't get in the first quarterly extension to December, you wouldn't be able to get in the second one. That's clear from the ledge that that's not the case. So even if you haven't been in JobKeeper up until now, you could start JobKeeper under the first quarter of the extension. And if you don't get it in the first quarter, you could get it in the second quarter of the extension. So there will be clients who don't qualify until the September quarter, for example. Till the December quarter, and who only get JobKeeper from January to March. So it is quite flexible. It is just JobKeeper. And it's just that from the 27th of September, working out on whether you get in is a slightly different set of tests than it was before. Does that answer your question? Yeah.
Worth noting as well, Andrew, that for people who are going to come on partway through, the ATO have got really strict about the deadlines and the cutoff. So if you do think you are down at a point and you're not on it, you need to let us know straight away to make sure we do the test and get you on before the cutoff, because they're not giving much leniency anymore.
No. Certainly we have to be a little bit careful that what happened previously is, because it was an absolute crisis in April, the ATO took a very generous approach, and a lot of deadlines that were in just kept getting extended. So even some accountants, I think, have got themselves into this mindset that the ATO is just going to give never-ending extensions to lodge things. And I think what we're all seeing, Aidan and Leanne and Stuart, I'm sure would agree, is what we're seeing is a tightening of the ATO's approach. The kind of gentler ATO that we got for a few months, which was quite disconcerting. They were almost friendly. I think a slightly more protectionist of the revenue approach is now in. Aidan, could you address Kathy's question if you've got that date there? And I've put Aidan on the spot there because he hasn't got the date. But if you, I'm sure Aidan will find that, Kathy.
We'll check that for the next round.
Yeah, we'll get back to you on that. Yeah. Okay, so the issue I wanted to go on to next to is employees. Employees are basically eligible in the same way as they were last time. So I've got a slide up that's only slightly modified with a little bit of bolded stuff here. So it's still the same basic rules around needing to be an Australian resident, and those people on 457s or 482s, I think is the new 457, they still don't get it on temporary visas. There's still the rules about casuals needing to be engaged in the business for at least 12 months. But one thing they have changed is they've left the original 1st of March 2020. That was the employee had to be there, had to be an employee of your business on that date. But they've also, they've effectively added a second date, which is the 1st of July. Without going into the complications of the legislation, the people who are eligible on the 1st of March and are still eligible are subcategorised as eligible on the 1st of March people, and the rule then says nothing changes for them. But there is a new category. Now, what that means is if you've added an employee who wasn't there on the 1st of March, but they are there on the 1st of July, if you qualify for the extension, you're going to be able to get those people in. Also, casuals who might not have been employed by you at 12 months on the 1st of March, 8, 9, 10, 11 months, by the 1st of July, if they're still working for you, they'll be at 12 months. So you can now add those in. So be aware that there will be an updating of those eligible employees. So that's the first change to employees. The second change is this new two-tiered system. So previously it was a straight, if you're in and you're eligible, you had to get a minimum 1,500 a fortnight. Under the new rule for the first extension from the 28th of September to the 3rd of January, people can either get $1,200 a fortnight or $750 a fortnight as their JobKeeper amount. And that depends on whether they worked more than 80 hours in one of two periods. Because we've got that 1st of March and that 1st of July date, basically what they've said is the 4 weeks before that. So that's effectively 4 weeks before the 1st of March is effectively February. 4 weeks before the 1st of July is effectively June. So in February and in June, did eligible employee Bob work more than 80 hours or not? If Bob worked more than 80 hours, then basically Bob will qualify for the higher amount. If Bob worked less, then prima facie only gets $750 a fortnight. However, in the grand tradition of the ATO being awesome, or they introduced a rule, which I'm having a look at because I still, and the rule basically says that there is an alternate reference period. And there's a series of components to this, which I don't want to go through in enormous detail, but I can. But essentially what it allows you to do is if someone was below 80 hours, you're able to, but you believe that there was a reason for that. So let's say you've got an employee who always works 90 hours plus a month, but in March, in February and June, in February they had 2 weeks annual leave and in June they had 2 weeks sick leave. So just so happens that in those 2 months they were below, but you're confident of the fact that they were typically higher. You are able to, in those circumstances, substitute an earlier 28-day period, which removes those circumstances and more accurately reflects reality. That's open to some degree of manipulation. There is also rules for employers who don't keep records of how many hours employees work. I can't imagine there's too many of them, but if you don't keep that record, there is the ability to make reasonable assessments and so on. That's actually more relevant, in my view, for eligible business participants. So some of you will be aware that you're either sole traders or you're partners, partnerships, trustees of a trust, or you're running through a company. You're not paying yourself a salary, so you didn't qualify for JobKeeper on that basis, but you got the money as what's called an eligible business participant. This same 80-hour rule applies to you. You simply, I think I've got a slide on this. You simply have to determine whether you're actively engaged in your business for more than 80 hours a month. Now, I could ask a general question here. Who that runs their own business is going to suggest that they are actively engaged in it less than 80 hours a month? And I think the answer to that is not many. To be fair.
Very much so.
So we don't know what actively engaged means, but I think if you're watching the footy and there's an ad break and you start thinking about billing, then you're actively engaged in the business, as far as I can tell. So it doesn't seem to me that that would be that difficult to get up to 80 hours. But anyway, so they have got that rule in. Now for the next period, 4th of January to the 28th of March, the second extension of JobKeeper, everything's the same except the rates drop. So you now have two different rates. So remember, it's $1,200 now or $750, and under the second lot it'll be $1,000 and $650. So this is all part of the government seeking to wean employers off JobKeeper. And certainly, if you look at the government's numbers, there is an assumption that most parts of Australia, certainly WA, there'll be a large drop-off in the number of employers that get JobKeeper going forward. But if you're in Victoria, obviously there would still be a lot getting this. So Josh has answered those questions, have you, Josh? Thank you. I didn't even know Josh was here. Oh, there he is. Just appeared down the bottom. Yeah, so just be aware that that's basically the change there. So employees, you've now got 2 dates, 1st of March as we had before and 1st of July. And you've now got this second category you've got to work your way through, which is whether they did more or less than 80 hours. There are some variations on that. If you paid someone more than $1,500, excluding any JobKeeper top up, they're deemed to have worked more than 80 hours. There is a bit of work around that, but if you've got a lot of employees that might be just under or just over, or that might be an issue because you have a lot of casuals and part-timers, it is probably worth a phone call to whoever you're dealing with just to walk you through that, just to make sure you're getting that right. I don't know. This is eligible business participants and other stuff. I mean, I'm not sure there's a great deal else there that, yeah, without going over the old ground of JobKeeper 1, it is effectively, as I've said, it's an extension. You're basing it on September quarter 2020. Am I down 30%? If I am down 30%, then I'm in. Do I have employees from 1 March this year that are still with me? Yes, they're in. Do I have new employees that I can add from 1 July? They're in. And then with those employees, were they greater than 80 hours or less than 80 hours in those relevant periods, which is February and June? And if they're greater than 80, then I get initially the larger amount of 1,200. If they're less than 80, I get the 750 as the base rate of JobKeeper. And that's really the way the system works. And as I say, the other issue is that when working this bit out, you have to stick to the method that you use for lodging and lodging your BASs. So if that's cash, you've got to use cash. If that's accruals, you've got to use accruals. That's probably as much lecturing as I want to do. So I'm happy to take questions or feedback from Leanne, Stu, Josh, Aidan. Anyone else?
I think you covered that pretty well. Leanne, was there anything you wanted to add? Aidan, Josh?
Just really important though, if you don't get it for this quarter, it doesn't mean you're not going to get it for the next quarter. So just bear that in mind.
And that's particularly important with this cash accruals thing, because what we're going to get is we're going to get people who've had a bad September quarter, but because they're on cash, that's actually going to pick up your slightly better June quarter where it all got paid in the September quarter. But what's going to happen in the December quarter is because you've had a really bad September quarter, the cash isn't going to come through. So you might be able to jump back in then. That's actually one of the flaws in the system. You're going to get the money after you need it rather than when you need it because you're of the basis of your registration. But yes, that's right, Leanne, is we need to monitor that. And I think it'll be more of an issue this time because you can't switch your methodology.
And I guess the other extension, Andrew, that you sort of touched over, just those alternate tests. There seems to be a lot of lack of knowledge in that space. So if you have lumpy turnover, you've grown pretty significantly, or you've set up a new division, or weren't in business same time last year, that just ask the question, because you may actually be eligible when you otherwise thought that you weren't. We've had a lot of good wins for clients in that sort of area.
And particularly be mindful of this one. I think Stu would agree that we've had a few clients under JobKeeper 1 who wouldn't ordinarily have got in, but they got in on the basis of a business restructure. So a business restructure could be something as simple as since September 19, you've reorganized your business in such a way that you might have a new income stream that you didn't have before. That could be enough to be a restructure. And obviously what that means is if you're comparing the September 19 quarter with the September 20 quarter, you're no longer comparing apples with apples because you added this new income stream. So there's a test that allows you to adjust for that. And we have had a couple of clients who wouldn't have got in on any standard test who did do. The definition of business restructure is not what we would often talk about when suggesting we might need to restructure your business, where we move it to a new entity or split it in two or do a whole range of things. It can be something as straightforward as of just a reorganization of methodologies and income types within your business. So there are opportunities in that test. So if you've got a decline in turnover, but you're not quite sure if you're at 30, do make sure you talk to us about those.
That's really important, is we're here to answer any questions. So if you've got any questions when you've reconciled your data file, just give us a call.
Yeah, well said. Okay, it doesn't seem like there's any more questions. So, Andrew, thanks very much for the update.
No
And
worries.
it's very, very informative as always. We're probably expecting some pretty substantial updates in the budget next month, or this month now, October.
Well, next week, in fact. So
Anything you want to talk through there, Andrew, high level? We'll do another webinar on the budget.
I think we're guessing. I think we've all heard that there's a lot of stuff out there, and the one that keeps sticking is the bringing forward of the various announced tax changes.
Yeah.
And the bringing forward of them either potentially to budget night or the 1st of January next year. And those are quite significant, particularly for people who are paying, at higher tax rates. They're not changing the top marginal rate, but they're talking about having a 30% marginal rate. Well, those changes would bring in a 30% marginal rate all the way from 47 grand through to 200 grand. So that actually makes, for someone who's on 200,000, that makes the best part of a $10,000 difference to your tax. But it also aligns for a lot of us our company tax rate for that first 200 grand of income, roughly with your marginal rate. So that creates some other issues around other areas that some of you might deal in, like Division 7A loans and dividends paid from your companies and various other non-sexy things, but that are important from a tax perspective. So there will likely be changes like that are announced next week, and that will lead to a fair bit of tax planning over the next couple of months. And as Stu said, if there's enough in there, which I suspect there will be, we'll probably just run another one of these in a week or so's time. Okay.
Welcoming it. Thanks, Andrew, and thanks everyone for joining. Look forward to chatting again and coming up with a budget update probably in a couple of weeks.
Thank you all. Cheers.
Thanks, everyone.
Thanks.
Bye.
Yes. Bye.
See ya.